Hi everyone, welcome back to Corporate Decoder, the place where we make sense of those complicated corporate filings. Today we're diving into an 8K report which might sound like it's about robots from the future, but it's actually about a company making moves in the real estate world. Stay tuned because this one involves billions of dollars. So let's see where that money is going. See a dot before we start if you appreciate getting straight insights from corporate documents. Make sure you're subscribed. We also have a Discord community linked in the description below. So what's the story? Equity Residential, a big name in the apartment business, is making a big financial play. They're issuing a massive amount of notes, essentially borrowing a lot of money. But what does that mean for the company and its investors? Let's break it down. First things first, this is a Form 8K filing. Companies use these to tell investors about big news that could affect the stock price. It's like a corporate bat signal letting everyone know something important has happened. The key date here is May 1, 2025. That's when Equity Residential's operating partnership, ERP Operating Limited Partnership, decided to issue a whole lot of notes due June 15, 2032. We're talking about $500 million worth. Notes are basically promises to pay back borrowed money with interest over a set period. Equity Residential is a real estate investment trust, or REIT. That means they own and manage a bunch of apartments and other properties. They make money from rent and they're always looking for ways to grow their business. Now, Operating Limited Partnership is Equity Residential's operating partnership. Think of it like a sidecar to the main company. It does a lot of the day-to-day stuff like owning and running the properties. So they are issuing $500 million in notes. This money comes with a 4.95 CV% interest rate, and they need to pay it back by June 15, 2032. That interest rate is the cost of borrowing the money. The higher the rate, the more it costs. This is a pretty standard interest rate considering the economic conditions. To make this happen, the company has a termed agreement with a bunch of big name financial firms like Citigroup, JP Morgan, RBC Capital Markets, and Wells Fargo. These firms are the underwriters, which means they help sell the notes to investors. They are basically the middleman between the company and the people buying the notes. These notes are being issued under what's called an indenture. Think of it as a contract that lays out all the rules for the notes. It says who owes what to whom and what happens if someone doesn't follow the rules. The company is following a bunch of supplemental indentures which are like updates to the original contract. Okay, so what's next? The filing includes a few exhibits, which are basically attachments that provide more details. There's the terms agreement itself, which spells out the deal with the underwriters. Then there's the form of the note, so you can see exactly what it looks like. Finally, there's a legal opinion from DLA Piper, Huld, a law firm, saying that everything is legal and above board. Let's take a look at the exhibits included with the filing. Exhibit 1.1, the terms agreement, spells out all the details of the deal between Equity Residential and the firms helping them sell the notes. Exhibit 4.1 shows you what the 4.95% note due June 15, 2030. That are one from Fulving them sell the percent note due June 15, 2032 will look like. Exhibit 519.23.1 include the opinion from DLA Piper LLH that the whole transaction is above board from a legal perspective. Finally, the document needs to be signed to make it official. On behalf of Equity Residential, Robert A. Garicana, Executive Vice President and Chief Financial Officer, and Scott J. Fenster, Executive Vice President, General Counsel, and Corporate Secretary have signed the document. Since the notes are technically issued by ERP Operating Limited Partnership, Equity Residential signed a second time as the general partner. So what does all this mean? Equity Residential is borrowing $500 million to fund its operations. They believe that they can use that money to invest in new properties or improve their existing ones, and that they'll be able to generate enough profit to pay back the notes with interest, or with both potential upsides and downsides. On the one hand, it shows that Equity Residential is confident in its ability to grow and generate profits. They wouldn't borrow that much money if they didn't think they could put it to good use. By investing in new or improved properties, Equity Residential could increase its rental income and boost its overall value. On the other hand, borrowing money always comes with risks. If Equity Residential's investments don't pan out as planned, they could struggle to make their payments on the notes, and if interest rates rise, their borrowing costs could go up, squeezing their profit margins. It's interesting they had to go through a bunch of different indentures from 1994, 2004, 2006, 2007, 2011, and 2016. This could indicate a lot of past financing activity. Overall, this is a pretty standard move for a company like Equity Residential. They're using debt to finance their growth, which is a common practice in the real estate industry. The success of this move will depend on how well they can manage their investments and navigate the risks of borrowing money. Alright, that's our breakdown of Equity Residential's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.